Hey everyone, in this video I'm going to talk about cost volume profit analysis. Super important topic, will come up again and again, so let's get started. Alright guys, this formula will be used again and again, and it's basically an income statement. But instead of breaking down our expenses by the type of expense, say cost of goods sold, salaries and wages expense, depreciation expense. No, instead of that, we're going to break the expenses down into whether they're variable or fixed. And so you have revenue at the top here. Got our total revenue, and then we subtract variable cost. Now, revenue minus variable cost is a special number called contribution margin. We'll be using that number quite a bit, so just keep that in mind. This is also a good time to point out the contribution margin ratio. Take your contribution margin divided by your revenue. There you go. What does that tell you? That says for every dollar of sales, I keep, whatever percentage of that before fixed cost. Very useful number. Anyhow, at that point, you subtract your fixed cost, and that leaves you with your operating income, aka your profit. Now, what do we do with this? Well, in this chapter, you're going to use this formula here and solve for any one of these variables. I could say, for example, in break-even analysis, what revenue do I need in order to have zero operating income, aka break even? At the same time, they may ask you, what fixed costs would result in a profit of $2,000, and you'd have to solve for FC. Alright guys, so very often you want to modify this formula. So at the top here, I have profit or operating income. What I'm doing here is just taking that formula I wrote vertically and just writing it horizontally. It's the same thing, I promise you. And in the second line, what I'm doing is taking revenue minus variable cost and dividing it by units, but at the same time multiplying it by units. So this Q here, this represents the number of units. Alright, so I'm dividing by units and timesing by units. Why would I do that? Well, it's going to be very useful for you. There will be a lot of questions that ask you, how many units do you have to sell to break even? And when you write it like this, you're able to isolate and solve for that Q. Alright guys, let's look at an example here. You have a company, Chillin' Time, makes ice cream bars, sells them for $1.50. Here is the deal on their operating cost. They have fixed costs every month of $1,780. Their variable costs are $1.10 per ice cream bar. Here's the profit formula to earn $1,000. So what they're doing is they're saying profit, our target is 1,000. If this were a break-even analysis, I would put in 0. But they say, okay, what do I need to do to earn $1,000? That means I plug in 1,000 there. Equals, and the way they've written it to me is a little counterintuitive. I would have put $1.50 minus $1.10 per unit times number of units being X, as I showed you previously. But whatever, they're saying $1.50 times number of ice cream bars X minus the fixed cost minus variable cost. That should give me 1,000. Solve for X. You're gonna find out they have to sell 6,950 ice cream bars in order to make $1,000. Alright guys, we touched on this previously, but again, this is a standard functional income statement. Costs are listed out by their function, and that is normally the way we do it. Let's have a look at a contribution margin income statement. So as you can see here, we have sales or revenue, but we're subtracting variable costs to arrive at contribution margin, and then we subtract fixed costs. So we're separating the costs by their behavior. You end up with the same profit, of course, but it's a very different presentation, much more useful for you as a manager. Let's talk about contribution margin a little bit here. We have the same company selling the ice cream bars. Contribution margin per unit is 40 cents. $1.50 minus the $1.10 variable cost. That is interesting, but usually you're going to want the contribution margin ratio. And that can be computed by saying, alright, total sales minus total variable cost, aka my contribution margin, divided by total sales, 0.2667. So every time you sell $1 worth of goods, you pocket about 26 cents before fixed costs. Now, why is this useful? Well, it's very important because you may be asked a question like the first one here. In that case, you don't really need the ratio. But in the second question, you're going to be much better off knowing that ratio. As you can see, if sales go up 1,050, how much will our income increase? Just times it by the contribution margin ratio. There you go, 280. The last thing I want to talk about in this video is target net income, or after-tax income, after-tax profit. So NI is net income. We've taken our contribution margin income statement and we've kind of expanded it here. You see we have this extra section there, after operating income, where we subtract income taxes and we arrive at net income. So you'll often have a question where they ask you, how many years do you have to sell in order to achieve, for example, $5,000 after-tax profit? Assume the tax rate is, say, 35%. In order to solve that, you just need to use this expanded formula. You don't know tax, but you do know tax is always equal to a certain percentage of of operating income, right? So that is kind of my hint to you for solving these problems. They usually won't tell you, hey, income tax expense is $2,000. They're not going to come out and say that. But they will say what the tax rate is. So if you know operating income, multiply it by whatever that tax rate is, you'll get income tax expense. It can be a little tricky to work backward, but you can do it.